Hello and welcome back to TCG TV. I'm Brody Tennant, and today's topic is commercial financing through COVID. So we got John Troiani and Fred Militello with us with 212 Mortgage. How you guys doing?
Doing well. Thanks for having me.
How are you?
I'm doing fine. So yeah, guys, tell us a little about 212 Mortgage and what you guys do.
All right. Well, I started 212 Mortgage Group about 15 years ago with the goal of being able to assist all different clients from the residential and commercial side who, let's say, were ultra bankable, so I can offer them the great rates and the great products, or slightly non-bankable. Maybe they had a credit issue, maybe they didn't verify all their income. I wanted to be kind of a one-stop solution for all my clients so that they could be reliant on me throughout their whole real estate life.
Okay, cool. And give us a little information about the type of projects you guys work on. Is it mainly, I know you guys do a little bit of residential and a little bit of commercial. You guys have a preference on type of deals that are you guys like to specialize in?
I wouldn't say we specialize in just one thing. We're kind of a jack of all trades. As Fred was kind of mentioning, we can offer great rates and great service to your top tier clients, but we can also be a little more flexible. We take the time to handle some of those more delicate files that need a little bit more work, need a little bit more help qualifying. We're a one-stop shop that can handle both.
Mm-hmm. Yeah, when it comes to, let's say, commercial, for example, I get a lot of referrals from local banks that basically say, hey, I got a great banking relationship with this client. Unfortunately, my bank's guidelines are a little more stringent. We look for a 700 credit score. We're looking for a nice debt service ratio or cash flow ratio. And also we're looking to see some more money in the bank. So can you help them out? Because we don't want to lose the relationship. So I'll step in there, and through certain lenders that we use, we have the ability to go bank statement for income or stated income for income on commercial.
So you guys have some
now
more flexibility.
The LTVs aren't going to, much more flexibility. And we can go up to probably 80% LTV. Rates are a little bit higher. They're mostly adjustables, 5-year ARMs, maybe 2 or 3 percentage points higher than what the market is bearing, but we get the deal done. We get the client into that property. We get the client, out of a potentially hard money loan or in a certain situation. We get them the property, and then over the next year or two, they can always refinance out.
Gotcha. So that could be really helpful in some of those deals that are either redevelopment or development deals where you're building some equity into the property and kind of the cash flow hasn't been really produced yet, but you guys can kind of be a little bit like leverage out to the bank a little bit while you're doing these projects. It's a place where you guys can step in that banks may not necessarily be eager to lend on to begin with, right?
Exactly. And it could also be situational. I always say my clients come from two ends of the spectrum on the commercial side. Mm-hmm. Clients that just really need help. They're a good business owner, but again, they might have a credit blip. They might have an income issue, or they may not have a ton of equity in the property, or the complete opposite side of that, where it's situational, meaning, hey, Fred, I just got a call from my landlord. He wants to sell the building. I have my commercial business in here, and I've been renting for a decade. I want to buy it, but I wasn't quite ready. Can you help me? Or the flip side of that, the building came up next door. It's a development deal for me because I own this parcel. I want to get in there, but I'm not showing enough income. Can you help me? And that's really what we do. We put our heads together to help on those situational type scenarios.
Okay. Yeah. For some people who may not know, can you explain just kind of the difference between commercial versus residential mortgages in general? Just touch on that.
So every bank looks at the same 3 pieces of criteria when they're looking to approve you for a residential and or a commercial loan. They're looking at your credit score. They're looking at your debt to income or your cash flow. And then they're looking obviously at your equity or your down payment. Typically, commercial banks really want to see credit scores of 680 or above just to get into the door. We can go down as low as maybe 620, 660. That's number one. So there's a little bit of a difference there. We can take a lower credit score, number one. Number two, when it comes to income, the bank naturally wants to verify the business income as well as the cash flow of the property.
Mm-hmm.
And they want to hit certain ratios, maybe a 1.25 ratio, where the rent payments that are coming in cover the mortgage, principal, interest, taxes, insurance, and a little bit of a 25%, let's say, buffer for vacancy, maintenance, and what have you.
Mm-hmm.
Some clients, the way they own their buildings or the way they do their books, number one, A, may not show their full income on their business tax returns, or B, don't really have certain leases in place, or they own or occupy the property, but they don't pay themselves rent.
Yep.
So when you go to a bank with that lacking, you're not going to get done. So if you come to us, we have certain lenders we deal with that will either use bank statements for your income. So they'll take a year or 2 years of your business bank statements. They'll add up the deposits. They'll divide them by 12 or 24 and hit them with a certain ratio, typically 75% of that. And they'll use that number as income. So you can see they would definitely qualify using that because, i.e., they mostly deposit all their money, but they may not report all their money at the end of the year. If they can't do the bank statement situation, then we have a no income verification scenario for them as well. And then the third thing naturally is LTV and equity. That we're pretty much capped at 70 to 80% loan to value on a purchase or a refi using one of those programs, meaning bank statement or no income. So that's really the difference. We have more options when it comes to how we view credit, what we utilize for income, and then what we utilize for down payment and equity.
As far as general differences between a residential and a commercial loan, for instance, a residential loan you can put down as little as 3% or even 0% on a VA loan, mainly because a lot of the residential loans are government backed, either through Fannie, Freddie, or through HUD, VA, USDA, whatever. So the government really takes a lot of the risk off of the banks. So for a residential mortgage, you really don't have to put down nearly as much money. And like Fred said, typically for a commercial mortgage, you do have to put down at least 20 to 30% in order to qualify.
Yep.
And of course, on commercial deals or on a residential deal, they're going to be looking at income via tax returns, W-2s, pay stubs, and they're going to look at your overall debt to income. Whereas on the commercial side, we're a little bit more flexible since we're really not looking at personal income. We're looking at either the business income or the asset itself, more of an asset-based lending type program where we're looking at the cash flow or the debt service of the asset.
Yeah, there's two differences that we see a lot is the investment real estate versus the owner-occupied real estate. And the owner-occupied really is more dependent on the business or the user. From what I've experienced on an investment property, it's more based upon the asset's production of cash flow.
Yes. And here, that's kind of that's the niche that I've carved out. Really looking at, it's really an asset-based lending, looking at the debt service of the property. So not looking at income via tax returns, pay stubs, W-2s. We're going to be looking at the rent roll or the lease from that property, looking at comparing it to the mortgage payment. Yep. If the rent can cover the mortgage payment plus a little bit, then it debt services and it cash flows. So that's the main thing we're looking at. We're looking at non-owner occupied investment properties.
And when you were mentioning, Fred, earlier the debt ratio, that's what they're referencing is the cash flow over the debt payment. Is you want to be 1.25 times the debt service, correct?
That's correct. And the way I was giving my answer to you earlier was basically explaining the difference between a traditional Main Street commercial bank and a commercial mortgage broker like ourselves. We can handle those commercial bankable products as well. Again, SBA type of scenarios or conventional commercial loans. We can handle those as well. But most clients go to their local bank for that because they have a banking relationship set up. It's when they may not be able to get approved or overcome one of their guidelines when they come to us or they're referred to us. But we handle both sides of it. We just get more of the non-conventional type of commercial lending. Yeah.
So, Fred, on the commercial side, what are you seeing different programs going on right now in the commercial mortgage space?
In the commercial mortgage space, we're used to seeing a lot of flexibility in the programs. During this pandemic, after March, a lot of the investors pulled back or pulled out of that space. So there were many lenders that I was using that offered no income verification loans or the bank statement loans that we touched upon, where what they've done now is they've gotten away, they've shelved the no income verification program, but they still kept on the bank statement program. The problem is they're not going to maybe a 75 or an 80 LTV on that. They're capping it at about 60, 65. I just quoted a gentleman yesterday who's looking to purchase a property. He's looking to buy a restaurant, and he's a restaurateur. The problem is I was able to get that client maybe 75% LTV funding pre-virus. Now, because of the industry that he's in and because of the guidelines, I can only get him 55% as a single tenant restaurant. So you're seeing a pullback in the loan to values because banks are guarding their risk. You're seeing a pullback in some specific industries that are quote unquote non-essential, or industries that may have been hit hard by the virus. So you're really seeing that. You're seeing a little bit more.
Restaurants be one of those. It's been one of the problems. Has been restaurants, people that aren't fully open. That's been one of the issues we've seen as well.
Yes, it's been restaurants. It's also been some office buildings where clients may or may not have had access to the PPP money and had to let a lot of their staff go. So now you have these office buildings or just commercial strip centers that are vacant or at maybe 20% capacity. They just don't have the money, they don't have the revenue to pay the rent. So now the cash flow doesn't look good. Again, when you're trying to bring that to a bank, they're looking at that property, and a lot of times, again, they're maxing those commercial loans at a 65 LTV, and they want documentation that the tenants and or the landlord has not been affected by COVID, or if they have, to what extent. Leases, they want to see the proof of lease deposits. They want to see updated P&Ls. There's quite a bit of stuff that they're looking for these days.
Also want to see if your forbearance is a big one as well. They're on the both residential and the commercial side. Definitely want to see that if you have taken a forbearance, that you're at least able to pay it back or be able to get current before refinance.
John, what else have you seen on the residential side? You seen anything other changes during COVID on the lending side for residential investment deals?
So are we speaking about residential non-owner occupied stuff?
No, not owner occupied. People owning
just
single family or multiple unit residential deals.
Okay. Yeah, I mean, like Fred said, I mean, the LTVs have been reduced. That's the first thing that that the lenders have done to limit their risk. Is just reducing the LTVs by about 5 to 10%. And then also looking at, again, looking more into the income. They want to make sure that the person's income hasn't changed or their employment hasn't changed due to COVID. Like right now I have to get, I'm getting, affidavits and forms signed by the borrowers, saying that they maintained their employment, their income hasn't changed, and that their income is going to continue the way it has been. So there has been some overlays there that we've seen and had to work with.
Gotcha.
Yeah, what I've seen also just happened to me yesterday is I had a client call me that says the bank has contacted my employer 3 different times already. Once at the beginning of the process, once about 2 weeks ago, and yesterday, because he's closing tomorrow. So again, the banks are just further having their third-party vendors, especially when it comes to income, re-verify that the client is employed, re-verify with updated pay stubs that they are still earning income. Also on appraisals, a lot of Fannie products are getting away with, I'm not going to say appraisal waivers, but I'm going to say no in-person appraisals. So they're not physically going to the property. They may be doing a drive-by and then pulling comps. The issue you run into with that is you may have a house that's gorgeously renovated on the inside. Maybe they spend an extra $20,000 on fixtures and floors that the appraiser's not really going to see. So we've had situations where values have come in a little bit less. Number one, because the appraiser can't see the property. And number two, because the lender is proactively pulling back a little bit on those LTVs. So what we've done in cases like that is we've actually had the client do like a FaceTime video or video some of the improvements in their home and email them to the appraiser to review.
Wow. Times are changing, that's for sure.
Yeah, you're right about that. Crazy world we're living in.
Yeah, the new norm, is that what it is? Or the new normal?
The new normal.
Yeah.
Also, just one other quick bullet point is, again, because my mind works on those three things, credit, income, and equity. Reserves. Lenders want to see reserves, whereas before reserves weren't as important. If you had 1 or 2 months of reserves in the bank, you were okay. Now lenders are looking to see 3, 4, 5, 6 months of mortgage payment reserves. Again, all during this time.
Yep.
We are starting to see some of the banks loosen up on some of the guidelines. John can get into what we were doing pre-COVID and during COVID right now when it comes to LTVs and loan amounts, but lenders are just looking for a little more security in this market.
Especially in the non-owner occupied space, which is kind of my specialty and my niche. So pre-COVID, I was consistently closing 80% LTV purchases, rate and terms, and cash out refinances on non-owner occupied investment properties. So those were really high leverage programs. For instance, Fannie and Freddie would only go up to about 75%
full doc.
Yeah, full doc. Whereas lenders before COVID were doing all the way up to 80%. Like I said, on purchases, rate and terms, and cash outs. And now after March, those programs have completely gone away. For about 2 months, we didn't see any of those programs come back. They were basically put on hold for 2 months, and now they're starting to come back. Albeit, but they're coming back with lower LTVs. So for our debt service program, which again is just based on the market rent, no other income documentation required, we're seeing a max of 70% for purchases and rate and terms. And for cash out refinance, the highest that we're seeing is 65. So as you can see, it's the LTVs and the leverage has been reduced quite a bit. It seems as though the lenders are kind of hedging their risk against a market downturn, and just trying to protect themselves and insulate themselves a little bit from leveraging themselves.
Looking at a potential, they want to limit the risk to prepare for potential some sort of recession or some sort of downturn in the economy long term, not only just right now, but long term.
Especially in the commercial and non-owner occupied investor space.
And to add to that, John, I would say especially in the non-owner occupied space, because the borrower is relying on the tenant to pay the rent so that they can pay their mortgage. With some of these mayors coming out and governors, what have you, and obviously institutions with some rent relief, tenants are living there not paying rent.
Yeah.
So how long can a owner go without that tenant paying rent? That's the issue, because then it becomes a domino effect. They can't pay their rent, the borrower can't pay the lender can't pay their investors, and
the banks, the banks don't want to be in a position where they're foreclosing on people. They're not in the business of holding on to properties through foreclosure.
The bank is always worried about their exit plan. How are they going to, if in the event of a foreclosure, how are they going to be able to market and sell this property? And if they're, they
want enough equity in it to sell it, basically.
Yeah, exactly.
Yeah.
And if equities are going down, if property values go down, they don't want to be stuck with a property that's underwater.
Mm-hmm. And what I've always said in this space and in the hard money space and other spaces, the bank doesn't want your property. They want their interest payment every month.
Yep. They're not in the business of holding property. They're in the business of holding mortgages with interest.
Making it.
Yeah.
You know,
So,
I always tell a quick 3-second story. You know, you see that there's a Starbucks on every other corner, but there is a bank on every corner. Reason being, you know, the amount of interest that they make off of a mortgage is tremendous. That's why they can have so many branches and so on everywhere. So again, they're focused on your interest, because on an average $300,000 loan over 30 years, you're paying in double that in interest. So that loan could be costing you $550 to $650 over 30 years.
one of the points you brought up about the rents being forgiven right now, and that's on the residential and commercial side by the landlords, or just by governments allowing that to happen. What are you guys seeing in regards to if they are forgiving rents? How do you go about when are they going to be paying them back, and kind of getting an idea that the rents are going to be paid by the tenant in the commercial or residential side?
On the commercial side, I have a fair amount of commercial clients that kind of bend my ear on a weekly basis, and they're telling me the same thing. They're saying, you know, the government has, quote unquote, put a rent forgiveness plan into place, but they haven't put a property tax forgiveness plan into place. Because as a landlord, they still have to pay property taxes, utilities, and so on and so forth. So a majority of them, believe it or not, I would say 70, 80% of my clients are still receiving their full or very close to full, i.e. partial rent payments from their tenants. It's a couple of them that aren't receiving the rents, and those are from clients that have been, you know, laid off or have been affected by COVID, meaning physically, like they caught the virus, so they were unable to work and so on. Some of the other ones have been commercial tenants that, due to COVID, had to close. But what's happened is they, again, they've received some PPP money, they've received some unemployment, and they are paying a fair amount of majority of their rent back.
Gotcha.
So I'm not
for the ones
seeing
that
it
aren't
as
able
much.
to, or like the ones that are pushing back, or maybe either adding it to the end of their term, which is seeing a lot of our landlords do, is, hey, we'll forgive rent for a couple months, but we'll add it to the end of the term. As businesses still are trying to pick back up, are you seeing a way to some sort of amendment to the lease needs to be signed and sent into the
yes, as a matter of fact, I was speaking to a commercial real estate attorney, a friend of mine, yesterday, and what he's been doing is he's been doing a lot of lease negotiations right now with larger tenants, you know, people that are occupying 2,500, 5,000, 75, 10,000 square feet. They are adding the difference onto the, usually they're giving them like a 6-month stay, and then they're going in and saying, okay, we're going to add up this rent and we're going to sprinkle it over the next 2 to 3 years, you know, of your lease. They're also going in and making some adjustments to the increases in some of the clauses on there as well. Some of the tenants are also unable to, a lot of these are triple net. So a lot of times the tenant is paying the taxes and the insurance and the utilities, and the tenant isn't able to. So here you have the landlord saying, I don't want to go into a tax sale or a foreclosure myself. So they have to pick that up. So it's really a negotiation, because ultimately the tenant wants to stay, the landlord wants them to stay. It's beneficial for both of them to work together to make that plan stretch out, as opposed to not. And believe it or not, a majority of businesses, they want to get back to work, and a majority of landlords are willing to work with their tenants.
So with 212 Mortgage, there's obviously, you guys do some things a little bit differently. What are some of the biggest things that you guys can provide that maybe some of the other banks do not provide their clients?
Well, I'll tell you, this morning I woke up at 4:53 a.m. with the word subordination agreement in my mind. What is that? What am I telling you? I have a client right now that's in the middle of a subordination agreement on a refinance that's taking just a little longer than I would have liked. So we value every one of our clients. At 212 Mortgage Group, you're a client to us. You're not just a file number. We work with dedicated teams at our lenders, and we really take your file home with us. So not only do we argue with our bank reps sometimes, with our underwriters and with our processing team, it's all in good faith because we want to really excel for the borrower. We want to delight the borrower. I always say I want to make the borrower a part of the process and not just subject to it. So we're out there every day fighting, thinking, planning, structuring, working files to the best resolution for our clients to get them the best rate and the lowest closing costs that they can qualify for. That's really what we do. We take it to heart. All our phones ring to our cell phones when we're not in the office. We are really, really client-centric. And, you know, our tagline is 212 Mortgage Group, experience the degree of difference. And we really would like all clients to come this way and experience the difference of the personal touch and the customer service and hand-holding that we do with them.
And I really try to be, and Fred touched on this, I really try to be a consultant and an advisor to my client. Since we don't work for one particular bank or lender, we want to put our clients in the best possible situation, you know, given their financial circumstances. So we really strive to be an agent for our clients and put them in the best possible situation for them, given their goals, objectives, and financial circumstances. We really put our clients' interests above the bank's interests, where the bank is really all worried about, you know, the one program they can make the most money off of, what's gonna give them the most proceeds. We're really just trying to put our clients in the best situation possible and fit their program or fit their qualifications to the right program, and not just try to squeeze them into whatever program the bank is offering at that time.
So for any of our investors looking for any commercial or residential lending, what's the best way to contact you guys?
There's a couple of different ways. One of the easiest ways is to just go to www.212mortgage.com. That's 212mortgage.com, and click contact us. Or you can just reach out to myself, Fred at 212mortgage.com, or John at 212mortgage.com.
Okay, cool. And we'll leave their links to their website and their emails below. But anything else you guys want to add?
No, just, you know, I've been doing this for 20 plus years. I've seen a lot of markets. I've seen the markets of the late 90s, the early 2000s, the mid 2008, 9, 10, and now, you know, the boom that we've had over the past couple of years, and then the COVID. So if you look back on this market over 20 years, it's kind of done one of these, but one thing has always stayed constant, you know, our belief in our clients, our faith and diligence in working with them. And those three pinnacles: credit, income, and equity. And if you focus on those, we can get virtually any deal approved.
So what do you guys see kind of going forward? Where do you see the market for commercial lending going from here on out? Obviously it's crazy now, but in the future, what are you potentially seeing?
Well, I would say personally, what I'm seeing is a little bit of a pause and a slight pullback. But the one thing that we can all be sure of is the resilience of the American consumer and the resilience of a corporation or a board that is responsible to their shareholders for profit. Banks have to lend. They're going to lend. You know, one of the reasons we were in that bubble about 10, 12 years ago is because of just the chase for yield, the chase for interest. A lot of these banks have been on the sidelines for the past 2 or 3 months, not generating the income that they're used to, not providing the yield to their borrowers, to their shareholders. What are you going to see? You're going to see these banks open up faster and sooner rather than later. And the programs may not be exactly as high as they were months ago, but they're going to start getting there. And by next year, hopefully, maybe by 2021, at the latest tail end of that year, you're going to see all these programs come back because they have to. The banks are making a ton of money on them, and they want to lend, and the investors have the appetite to make that kind of return. That's really what I'm seeing.
All right, guys. Well, thank you for coming on. That was very insightful. If anyone wants to reach out to them, again, their information will be below. But thank you guys again for coming on, and have a good day.
Thanks, Brody. Appreciate it.
Thanks for the opportunity.